We're diving today into one of the most frustrating and just plain strange mysteries in the tech sector right now, the trade desk.
Yeah.
Ticker TTD.
Right.
This is a company that, on paper should be a home run. It's profitable. It's founder-led by Jeff Green. It has these insane 80% gross margins. And it's positioned right in the middle of this huge secular shift of ad dollars from old school TV to digital streaming.
Exactly where you want to be.
But then you look at the stock chart and it's a completely different story. Yeah. It's a horror show.
It really is.
If you go back to its peak, December 2024, it hit an all-time high of $141.53.
Wow.
And right now, as we're talking in late 2025, the price is hovering around $39. That is a collapse of nearly 70% in less than a year. The stock has been utterly decimated.
And that's the mystery, right? Because the core of it is that this massive catastrophic drop happened while the company's actual business kept growing.
It kept growing and making money. The stock is just stuck. It seems totally unable to recover, even with these strong fundamentals.
The moment that really broke it, the one that shocked Wall Street, was in August of 2025. After their Q2 earnings report, the stock just cratered. It fell a staggering 38% in one day.
One day. And it wasn't even a huge miss, was it?
No, that's the thing. They didn't have a debt crisis. It wasn't some massive revenue miss. They actually beat revenue expectations slightly.
So what happened?
It was pure fear, a visceral market reaction to really two things. One, rising macro pressure slowing down ad spend in general. And two, the big one, the growing competitive threat from giants like Amazon. The market it permanently reevaluated the entire ad tech space overnight.
It's just brutal price action. And that leaves us with this huge tension. The bulls, they look at the chart, they see the $39 price, and they see a bargain.
Yeah.
A high-quality, founder-led platform ready to dominate.
While the bears, and frankly the market as a whole, are arguing that the stock has been permanently derated. That's the key word. They believe the market will simply never give it that premium multiple again, not with slowing growth and the walled gardens looming.
So that's what we have to unpack today. Is the trade desk quietly building one of the most important ad platforms of the future, something that's got to compound returns for decades?
Or is it just a great company with a broken stock that may never get back to those old highs?
Welcome to Facts Not Forecast, your daily edge in the stock market. Facts, insights, and opportunities you won't hear anywhere else.
Okay, so to really get this, we have to move past just calling TTD ad tech. It's more specific than that.
Right.
The Trade Desk is a self-service, cloud-based demand-side platform, a DSP. It was founded way back in 2009.
That DSP designation that kept coming up in the sources as being absolutely critical. So for you, the listener, why is being on the demand side, the buyer's side, such a huge advantage here?
Oh, it's everything. A DSP is where the ad buyer, the marketer, lives. TTD is the software they use to create, manage, and, optimize their campaigns across every format.
Display, video, audio.
And the big one, connected TV. By focusing only on the buyer, TTD stays completely neutral. They're agnostic, they don't own the media, they don't sell their own ad space, unlike the giants.
So they aren't competing with their own customers.
Never. And that builds a huge amount of trust with the world's biggest brands. Their whole niche is the open internet.
So everything that isn't Google, Meta, or Amazon.
Exactly. TTD is basically the tech backbone for programmatic advertising in that massive and frankly faster growing part of the internet. It positions them perfectly for these massive trends, especially CTV.
It really is a compelling strategy. You're solving problems for the big spenders, right where the money is flowing.
Yeah.
And yet, we have this 70% collapse. So let's really break down the mechanics of that, because a drop that big should mean the business model is on fire, right?
It should, but it's just not there in the P&L. It really boils down to, I think, market psychology and just broken expectations. The panic was fueled by three things. First, it was just expectations versus reality. TTD was priced for pure, unadulterated hypergrowth. I mean, before 2023, you were looking at revenue increases of 30, even 40% a year.
And to justify a PE multiple over 100, you need that pace to continue forever.
Indefinitely. And the second it didn't, even if they still grew at a really solid 20%, that premium just vanished.
It's like you're priced like a Ferrari, and you slow down to 100 miles an hour, and everyone freaks out.
Precisely. The valuation was based on a future that got pulled forward during the pandemic. So when those Q2 2025 results came out and signaled slower growth and raised those Amazon fears, the market just panicked.
Which brings us to the second factor. Good company, bad macro timing.
Absolutely. Digital ad spend is, it's highly elastic. When the macro headwinds hit in 2025, advertisers cut their budgets. It's one of the first things to go.
And the market got spooked that this was a permanent slowdown, not just a cyclical one.
Right. And then you had key areas like CTV maybe not scaling quite as fast as investors had hoped, which just injected more uncertainty.
So the market basically re-rated the stock. That's the third and maybe the most damaging part of this whole thing.
That's the absolute core of the bear case. The valuation status of TTD changed like overnight. It went from being valued like this pure, high-growth, mission-critical software platform
Where 100 PE is fine.
to being labeled an ad tech cyclical. And if you get that cyclical label, the market assumes you just ride the economic wave up and down no matter how good your company is. It forces a much, much lower premium.
That's the fear that's baked into the stock price today, isn't it?
Completely. Its PE dropped from peaks way over 150. And even now, at around 45 times earnings, it's still seen as expensive by some. But the market has basically decided it won't pay that triple-digit multiple again unless growth just massively reaccelerates.
It just feels insane.
Yeah.
A 70% collapse for a company that's still growing over 20% with maybe the best balance sheet in its peer group. Let's look at the numbers the bears seem to be ignoring.
Yeah, this is where it gets really interesting. If you strip away all the sentiment, the core financials they're outstanding.
Okay, let's hear them.
Looking at the trailing 12 months up to September 2025, revenue hit $2.79 billion. That's up a very healthy 20.8% year over year. And forecasts are for that to continue.
So not stagnation at all. It's solid growth.
Not at all. And then you get to the margins. The sources call them phenomenal for a reason.
Yeah, this is the part that stands out. We're talking about profitability you see with massive software giants.
We really are. The gross margin is a whopping 80.69%.
80%.
To keep 8 out of every $10 that comes in, it's incredible. It tells you their cost of revenue is tiny. They're selling software, not stuff. And the net margin is actually accelerating. It's up to 16%. This is a business built to compound.
Okay, so 80% margins. How are they pulling that off if they're not Google or Meta? Why hasn't a flood of competitors just dragged that profitability down?
It goes back to that platform advantage, that DSP. Because they're the neutral operating system for the buyers, brands centralize their spending through TTD to reach everyone outside the walled gardens. It lets them scale without huge content or data costs. They just focus on the tech.
And that balance sheet, you mentioned it. They're essentially bulletproof from a debt standpoint.
This is probably the best counter-argument to that whole cyclical label. TTD is debt-free.
Zero debt.
0.0 total debt, which means they are not beholden to interest rates or debt covenants when things get tough.
And in terms of liquidity, what does that let them do that, say, a competitor with a lot of debt can't?
It gives them immense optionality. Their current assets are $5.1 billion, way more than their short-term liabilities of $3 billion. They're sitting on $1.45 billion in cash.
So they can invest through a downturn.
They can invest aggressively in R&D and things like their identity solutions and AI, while their weaker competitors have to pull back.
Okay, so we have this picture. 80% gross margins, zero debt, 20% growth. On the other hand, a stock at $39, trading at 43 times earnings, which is still way higher than its peers.
Yep. The peer average is around 25.
So what breaks this stalemate? What are the actual catalysts that could drive a recovery?
Well, the recovery hinges on the acceleration of those big trends TTD is already built for. The first one is obviously connected TV. The shift of ad dollars from linear TV to digital streaming, that's just a matter of when, not if. And TTD is a leader there.
But the biggest focus, and maybe their biggest potential moat, is solving the identity problem, right? In a world without cookies.
Absolutely. This is the whole long-term thesis. TTD is pushing the adoption of UID2 or Unified ID 2.0. This is their answer to third-party cookies going away.
And unlike what Google or Apple might do, this is an open source framework.
That's the key. It's an open source encrypted identity framework for the entire open internet. Instead of letting a walled garden dictate the rules, TTD is trying to build the neutral plumbing for everyone else.
So if UID2 takes off after cookies are really gone, TTD's platform becomes indispensable.
Exactly. It's a huge risk, but it's also a massive opportunity. And then you add in their AI tools.
Kokai.
Correct. Their AI tool, Kokai, is all about improving ad performance for the buyers. The more complex advertising gets, the more you need AI to optimize it, which just reinforces their tech advantage.
And from a pure valuation standpoint, the bulls are feeling pretty good. A common DCF model I saw puts TTD's fair value at around $81,
Right, which suggests the stock is more than 50% undervalued right now.
a huge margin of safety.
A huge theoretical margin of safety. But we have to look at the risks that drove the crash in the first place because they haven't all gone away.
Let's run through those headwinds.
The first, and most obvious, is the valuation premium. Even after this huge drop, a PE of 43 is still expensive compared to peers. If the market keeps treating it like a cyclical stock, that multiple could actually shrink even more.
Meaning there's still downside risk, even if the business does well.
Exactly. And you can't forget the competitive pressure. That's the core fear. Amazon is aggressively building its ad network. Google and Meta have data moats TTD just can't replicate. That fear is what keeps the multiple suppressed.
Plus, the growth of things like CTV could just be slower than everyone hoped.
That's a real risk. CTV supply is fragmented. There are too many platforms. It's messy. If that open internet shift happens slower than expected, TTD's recovery is going to be slow and choppy. And right now, the technicals are flashing a strong sell signal, which doesn't help.
So what is the final investor takeaway here? How do you balance this? A great company with immaculate financials versus a stock that's just been so severely derated?
The bull case is all about quality and patience. You have this financially perfect, business debt-free 80% gross margins, and this is important, accelerating earnings growth over the past year.
Up 42%.
42.3% year over year. You combine that with huge secular trends like CTV and identity solutions. The founder owns almost 9%. It checks almost every box for a long-term compounder.
But the bear case forces you to ask, is that enough to bring back the hypergrowth multiple?
Exactly. The bears argue that this valuation sensitivity is now structural. The stock is still expensive for its current growth rate. The 70% decline shows how fast the market can panic. The fear is that the ad tech cyclical label has just stuck. And the market may never pay that premium again, no matter how great the balance sheet is.
It really is the perfect paradox. High-quality fundamentals meeting a permanently skeptical market. The trade desk is profitable, founder-led, financially strong, and right at the center of the open internet ad revolution. But the stock still hasn't recovered. So the real question for you, the investor, is TTD a long-term compounding opportunity at this price, or is it a great company where the story is still better than the stock?
And maybe consider this as you think it over. The sheer size of that drop, nearly 70% in a year, happened while earnings growth accelerated. It climbed over 42% in the last 12 months. That disconnect forces you to ask if the market's fear was a massive overreaction that just isn't supported by the actual numbers on the P&L statement.
Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.